I'm Ryan Lightfoot-Brown from Chelsea Financial Services. We're joined today by Anthony Srom, manager of the Fidelity Asia Pacific Opportunities Fund. Thank you very much for joining us.
Welcome.
Now, Asia area very much in conversation at the moment, especially with relation to the US-China trade wars. What is your view on this, and how does it affect some of the positions you're taking?
I think the trade wars are basically a small part of a bigger issue. I think the market's overly focused on trade, which can present itself with some opportunities for the fund. So, for example, last year I think markets were very negative. Trade war discussions, GDP growth, we took advantage of that to go overweight China. A lot of long-term structural winners were sold off as cyclical exposures. Subsequently, China's rallied somewhat, we've taken money off the table, but again, I think market sentiment and momentum can shift quite substantially, and we take advantage of that.
Okay, and you currently do hold a large amount in China and Hong Kong. Is that just because of those value opportunities, or is there a longer-term reason behind that?
Both. So again, the companies that are of most interest to me would be the long-term structural winners at good valuations. And we had a couple of bites at the cherry in the last 12, 18 months. So something like a Han's Laser, Zhejiang Sanhua. So Han's Laser obviously in the laser industry, manufacturing. Zhejiang Sanhua in something as bizarre as aircon modules and components. But again, very long-term growth opportunities for both structural winners. And we picked them off at what I felt were good valuations.
Okay, and in your portfolio, you don't hold some of the names that we usually see in other people, so Baidu, Alibaba, Tencent, Samsung, the so-called BATs. Why don't you hold those?
At the highest level, I don't think risk-reward makes sense. I think a lot of people are focused on the rewards, not so focused on the risks attached to these companies. Sitting in Asia, a long-term view on Alibaba or Tencent's 1 year. If you're being asked to pay 25, 30 times earnings for that, you've got to look further ahead. So in terms of my thinking, I see a lot of risks around Tencent, Alibaba, Baidu. I think Baidu's really struggling on search. I think they've lost that. Tencent, Alibaba can be things such as accounting quality. I don't think it's as good as the market believes. Transparency is low. A lot of risks to their business models, such as digital assistance and platform change. How do you adapt to that? And Samsung's in a different kettle of fish. It's more in memory, which is highly cyclical. And I think for the last 12, 18 months, the market's been jumping the gun on a memory recovery around DRAM. They're currently quite ebullient that inventories have peaked. But again, I don't see the value in Samsung.
Okay, thank you. Now, one country in your investment remit is Australia. It's famously not had a recession for, is it 28 years now, I believe? But it's one of your biggest underweights. Why are you staying away from the region?
Australia is really dominated by two sectors, materials and banks. I think banks are expensive, low returning, going to get worse. Materials, again, I think people have jumped the gun on this modern monetary theory or MMT principle where fiscal and monetary policy combine. BHP Rio have been bid up. I don't really see the value in that. So if you exclude those two sectors from Australia, it's very hard to be overweight. And again, in the residual part of the Australian market, not a lot of stock ideas to date. So it's as you mentioned earlier, we've allocated the money to Hong Kong, China.
Okay. And we'll just go on to India, if we may. It's one of the most popular markets for investors over here. It's really captured sort of the imagination of people, that huge growth story, but hasn't done particularly well this year so far, despite the election. Do you think that's a bit of a post-election hangover, or is there something else behind it?
I think there's something else behind it. I think structurally, India's going to struggle for growth. They've got positives like demographics, but this capex cycle that people keep talking about isn't eventuating. I think there's a lot of problems in the banking sector. So again, transmission of credit through to the economy is not really functioning. The public sector banks have got a lot of, let's call it, non-performing loan issues they've got to work their way through. So given they're the largest part of the banking sector, I think Indian GDP growth will struggle aside from any macro events that could also occur, i.e. the trade war that you mentioned earlier. Yep.
Well, Anthony, that's been really interesting. Thank you very much for joining us today.
Welcome.
And for more information on the Fidelity Asia Pacific Opportunities Fund, please visit chelseafs.co.uk.